Hey everybody, today we're going to be diving into one of the most aggressive and intriguing cover call ETFs on the market, and that is TSPY by Tappalpha. Now this is the SPY Growth and Daily Income ETF by Tappalpha, and it's a little bit different than most of the other cover call ETFs you probably have heard of. Now we're going to be comparing this one to SPYI and JEPI because those are two ETFs that actually track the S&P 500, and we are trying to compare and see which one could be better, which one is worse, and which one you may be wanting to add to your portfolio. The cool thing about TSPY, it has a yield of about 13.45%, which is crushing SPYI and almost double of JEPI. So you're going to get a great ETF that's got a good yield, that's got a pretty good price appreciation or total performance compared to the S&P 500 and compared to these other cover call ETFs, and you've got one that's just a little bit different. Now there are definitely risks to this ETF, and we'll be going over those later on in the video, but kind of stick around, see what you think, and let me know in the comments. Do you own TSPY? Alright, let's get on to the video. Hey guys, my name is Steve, and I run the Frugal Expat website where we try to help people to save more and invest better. And today we are talking about TSPY. So what is TSPY? So TSPY is a Tappalpha product that tracks the SPY, and it sells 0 DTE options on SPY. So if you really want to know exactly what that means, 0 DTE is 0 days to expiration. What that means is what it's doing, it's got about 99.5% of its portfolio, which is SPY. So they're taking SPY, as in the index fund or ETF by Spider, they're selling daily options that are 0 date to expiration. So basically they're selling those cover calls on SPY, 0 date to expiration. So they're selling one today, closing it today, selling one tomorrow, closing it tomorrow, and so on throughout the week. And that's how they're making income for people. Now, it definitely has some risk, and that is part of investing as well. And so we'll talk about this too. So this ETF has been around since August of 2004, and it doesn't really have that much assets under management. But what it's doing is it's got the core portfolio is SPY. So if you want a piece of the S&P 500, this ETF has a piece of that. I mean, it's got 99.5% of its portfolio in SPY. Now they're selling cover calls to create income, and they're selling them every single day and closing them about every single day. And this is the hope is that as time decay happens, that the premiums that they sell in the morning are going to kind of decrease, and so they'll make a lot more premium when they close it out on the end of the day. So, but the problem is when they're doing it, and this is the trade-off of this option, is that they're gonna have a capped upside. So the hope is, you know, if the SPY is maybe going sideways, they'll make more money. Because if the market is going crazy, well, you're gonna have a capped upside. And we have seen this with a lot of things that are going on in the market right now. When the market goes down, of course, they're gonna capitalize, but when the market is shooting up and it goes up 2 or 3% a day, or even 1% a day, I mean, you're gonna have a capped upside, and so that market price appreciation will not be there as much as if you're just holding SPY by itself. Now, if you are an option trader and you had SPY and selling options yourself, you could obviously roll these into a different day or even different week, and so you can collect that. You can even do that with monthlies. And so this is doing dailies, and it's just a little bit different than a lot of others. Now, if we look at SPYI, which is a NEOS product that does cover calls on the S&P 500, it does a little bit different. Instead of doing daily cover call options, they're doing monthly ones. So they're selling out of the money monthly cover call options on assets that are in the S&P 500. And TSPY is doing cover call options daily on SPY. So that's a little bit different on the way they do things. Now, NEOS SPYI does about anywhere between 11 to 13% yield, while TSPY does a yield of about 13 to almost 15%. So you have a little bit more yield with TSPY, but it's a little bit different strategy on doing these things. Now, the expense ratio may eat up into some of your money, but that may not be a concern to you. Now, the expense ratio is 0.77%, which means it costs about $77 for every $10,000 invested. And so that could be maybe a deterrent for you to maybe not own this ETF, or it could be just thinking, well, if you do the numbers with the yield, TSPY is doing much better, maybe better than a JEPI or SPYI. Now, if we were to compare TSPY to maybe SPYI and JEPI, we're going to take a look at the yield, we're going to take a look at the performance, the expense ratios, and how it affects the overall yield and performance. And we're also going to take a look, if this could be something that you may want to add to your portfolio. Of course, there's risk, and so we'll discuss some of those other risks at the end of the video. Let's get to it. Now, TSPY does have a yield of about 13.45%. So if you invested $10,000 into this ETF, you'll be getting $1,345 every single year. And so that is amazing. I mean, if we break that down, that's about $112 a month. And so that's some pretty good income. Now, if we looked at SPYI gets a yield of anywhere between 11 to 13%. And so you're getting about $1,100 to $1,300 per year. And so it's a little bit less. And then with JPI, it's doing anywhere between 7 to 9%. So you're getting anywhere between $700 to $900 for that yield. And so that's a little bit different. Right there, TSPY wins because it's got the higher yield. And that's pretty good. Now let's take a look at the performance. So TSPY over the last 1 year has a performance price return of about 1.86, while SPYI is 3.008. And you have the S&P 500 sitting at about 16.9, and you have JPI, which is down about 2.86% or 2.96%. Now, if we take a look at year to date, it's a little bit different. TSPY is up 3.83%, SPYI is up 4.11%, the S&P 500 is up 16.89%, and JEPI is up about 0.12%. Now, those are price returns, and that is showing you that there's not much NAV erosion going on, and so it's continuing to grow. Now, if we looked at total return with these dividends and distributions reinvested for the long term, you're going to see some great numbers from TSPY and SPYI and the S&P 500. Now, TSPY is up about 16.94%, while SPYI is up about 15.19%, and the S&P 500 is sitting at 16.89%, with JEPI doing about 6.7%. So as we can see that TSPY is beating the S&P 500 with their distributions reinvested. It's beating SPYI and it's crushing JEPI. So it is a great ETF that's got some pretty good performance. If we take a look at the expense ratios of these three ETFs, TSPY is 0.77%, SPYI is 0.68%, and JEPI is 0.35%. Right there, TSPY is the most expensive. Well, it's costing you $77 per $10,000 invested, which is almost double that of JEPI, and it's about 9 basis points more than SPYI. Now, you may be wondering, and you may be saying, well, Steve, it's got a better yield. And so let's jump in those numbers just to see how much it really is saving us or even costing us in the long run. So if you have an expense ratio of 0.77%, it's going to cost you that $77. Now, if the yield is 13.45%, we are getting $1,345 in income. Now, if we subtract that $77, now our yield is sitting at 12.68%. That 12.68% is beating SPYI. It's beating JEPI. So does this expense ratio really matter in the long run? Well, right now we're seeing that the yield makes up for it. And so that's kind of a portion of why maybe you should be investing in this over SPYI, because right now the expenses really don't matter, but the yield is doing much better with TSPY. Now, one of the biggest differences we're going to see with these three ETFs is the assets under management. Now, JEPI's been around since like 2020, so it's got about $30 to $40 billion in assets under management. It's also with a company called JP Morgan. So if the fund were to fail, then there's a little bit more liquidity and they can probably move your assets to something else. Now, SPYI is a little bit newer than JEPI, and it's got about $5 to $6 billion in assets under management. Now, it's not as big as JEPI, but it's got billions in assets under management. It's with a company called Neos, which is newer, but Neos is growing quickly, and it's got a lot of great covered call ETFs like QQQI, it's got IWMI, it's got a lot of other ones that you could buy and hold for the long term. It's got a pretty good company with the assets under management, and it's got about 5 to 6 billion, so it's continuing to grow. TSPY is with Tappalpha. Tappalpha is a very new company, but the problem with TSPY, it only has about $114 million in assets under management. It's a much smaller fund. And so if you were to invest in this, your hope would be that it grows in assets under management, it grows in liquidity, and this company of Tappalpha continues to grow. Because what happens if they don't get enough assets? What happens if they don't have enough investors? Well, they may have to shut it down. They may have to shut down the company, and then they would move your money from this place to this. So it may not last as long as maybe some people will expect. That's the problem with TSPY. That's one of the huge risks. The huge risk is it doesn't have the following of an SPYI. It doesn't have the backing of a JEPI. And so you're gonna have some problems. You could have some problems in the future. So that's one of the hugest and the biggest risks that's with TSPY. So you have a lot of things that could go wrong, but you have a lot of good things. I mean, a 13.45% yield is a great thing. You have the S&P 500 with SPY. That's a great thing. There are some great things apart about this ETF. Now, is this something that I may want to invest in? Possibly. Maybe I want to do my own 0DTE. Well, maybe, probably not. Maybe I just want to stick with a good ETF like a SPYI or even a QQQI. Those are some possibilities, or even a GPIX, or even maybe some other cover call ETF that tracks the S&P 500. There are some great options out there. And so maybe I may not want to chase yield. Maybe I want to chase stability. And so that could be something that I may be looking into. So let me know in the comments. Do you own any TSPY? Are you looking into this ETF? What are some goods and bads that you have noticed if you own this one? What are some other ETFs I could be looking into? I know some of you guys leave some great comments, and I like to answer almost every single one that I can. And so leave a comment, let me know. And if you really like this video and you want to follow and see a great growth in income ETF, check out this video. And I'll see you in our next one.